Taxes are exceptionally confusing. In case you've ever wondered, the Internal Revenue Code, that's the IRS's tax rulebook, is over 4,000 pages long, and that depends on who you ask. Some sources say it would take over 70,000 pieces of paper to print the thing out. Now, no matter which end of that range is closer to the truth, that's a lot of room for complexity, which is kind of ironic because those codes are supposed to provide clarity to honest people trying to calculate their taxes. Adding to that confusion is the occasional tax code policy or term for a tax that exists, but is rarely actually collected by the government. Now, just such an example exists in the gift tax. Now, technically, we all owe taxes on gifts or cash or other assets we give to others, though the IRS does provide an annual exclusion amount. But even when givers reach this annual exclusion, many don't realize they can actually give more without incurring any additional taxes, ever. There are a few different ways this can be accomplished. To understand these, let's walk through gift taxes step by step. Now, as we do this, please keep in mind that I am not a tax professional or an attorney. You should seek professional assistance for any of the comments or things we discuss that you have questions about. All right, first we're going to start off by talking about the annual gift tax exclusion. The IRS limits the amount of money that one person can give to another individual tax-free each year. Now, there are actually some good reasons for this, mostly rooted in the basis that people would engage in a lot of gift giving to avoid taxes on estates or the transfer of other assets. Now, this would be especially true for purposes of legacy planning. If you could sidestep a litany of taxes for your descendants by just giving them their inheritance before you died, wouldn't you do that? In fact, many people do, and it can be a wise move from an estate planning standpoint. So each year, the IRS permits each and every taxpayer to give cash or other assets to whomever they wish up to an annual exclusion amount. For 2024, this amount is $18,000 from one person to another. If you combine a gift with your spouse, you can give up to $36,000 to any one person. Do you have a child or child-in-law? A married couple could give them up to $72,000 a year. That's $18,000 times 4 without paying a penny of tax. That's $18,000 from the father to the son, the father to the daughter-in-law, $18,000 from the mother to the son, mother to the daughter-in-law, or vice versa, however, whatever. Anyway, there's no limit to the number of people you can give gifts to, just a maximum on how much you can give to each person. All right, so what if you give more than this amount? Now, you'd think since the IRS itself calls this whole code a gift tax, you'd owe a tax if you gave beyond the annual limit. But you don't. At least you probably don't. You see, in addition to the annual exclusion, the IRS provides everyone with a lifetime exemption. If you die in 2024, your lifetime exemption will be $13,610,000. So let's review. In 2024, you have an annual exclusion limit of $18,000 and a lifetime exemption of $13,610,000. If you go over the annual exclusion amount, the amount you give over and beyond the annual exclusion is deducted from your lifetime exemption. And metaphorically, I like to think of this as a system of buckets in a big tank. All your gifts have to go through the bucket or the tank. Now, each year, the IRS gives you an endless number of buckets. This represents your annual exclusion. You can fill each bucket to your heart's content for any one person on earth. By the way, gift taxes don't apply to gifts given to a spouse in any amount, but you also get a big tank, and the tank is your lifetime exemption. If your bucket starts to overflow, the excess spills over into the tank. At the end of the year, you report to the IRS on Form 709 how much went through the tank from all your collective bucket spillover. The amount that went into the tank is deducted from your lifetime exemption. The tank's volume is reduced by this amount at the end of the year, and you never get it back. If you give over and beyond your lifetime exemption, you'll owe gift taxes on each and every dollar you give to another individual from then on. If your estate exceeds this lifetime exemption, then the estate will pay estate taxes on the value of the assets that exceed the remainder of your lifetime exemption. Let's look at a couple of examples to explain. Let's assume generous George has done well in life and he loves to share with others. His net worth is over $20 million and he decides to give cash to each of his 10 friends in the amount of $25,000 apiece. At the end of the year, George will need to complete Form 709 to report his generosity to the IRS, who will make a note on George's file that his lifetime exemption has been reduced by $70,000. Why $70,000? Because $70,000 is the amount that George gave beyond the annual exclusion amount of $18,000 per person. $25,000 per person minus $18,000, the gift exclusion amount, leaves $7,000 per person over. He gave it to 10 friends, so that's $70,000. Now, George lives 9 more years total, and he keeps giving his 10 friends $7,000 beyond the annual exclusion, resulting in a $70,000 reduction each year to his lifetime exemption, for a total deduction of $700,000. For simplicity, let's assume the lifetime exemption in the year that George dies is $15 million and his estate was worth $25 million. Since George used $700,000 of his lifetime exemption already, the portion of his estate subject to state taxes is $10,700,000 instead of $10 million. I'm sure George's heirs will be just fine, even with a slightly reduced inheritance. Now, to see a better way to approach this, let's look at Logical Linda. Logical Linda is George's financial equal in every way. The only difference is she combines her gifts with her husband, Logical Larry. As a result, Linda and Larry can give away up to $36,000 to their friends, and none of their gifts impact their lifetime exemption. When they pass away, their estate is spared the taxes on $700,000. And just so you know, estate taxes on $700,000 is worth about $280,000 in 2024. That's 40% of $700K. Estate taxes are actually progressive, just like income taxes, but I don't want to take the time to put the table up here and calculate that exact amount on $700K. Just know it's about $280,000. Now, granted, we're talking about people with mega millions, but $280,000 is $280,000. And Larry and Linda were able to save it without any extra effort. Now, something else to keep in mind is you can reserve the lifetime exemption of a deceased spouse. So let's assume that our friends Logical Linda and her husband Larry die at the same time in a tragic accident. In that case, their estate would receive a double lifetime exemption. So in 2024, that would be $27.2 million. Since their estate value is $25 million, it would pass to their heirs completely tax-free. But imagine for a minute that Logical Linda's dear husband Larry passes away 10 years before she does. What if at her death the estate is worth $25 million, but that year the lifetime exemption amount is only $15 million? Well, Linda's estate would owe estate tax on $10 million. That 40% marginal estate tax rate would be $4 million. However, there is a way for Linda's estate to reserve Larry's portion of the lifetime exclusion. If Linda files Form 706 within 9 months, she can keep the amount of Larry's lifetime exemption and add it to her own estate when she dies. So in the example we've been using, Larry dies with a $13.61 million exemption and Linda dies a decade later with a $15 million exemption. By sending in Form 706, $28.61 million of their estate would be exempt from the 40% estate tax. Now, you may observe this and think it's kind of trivial since you're not worth $25 million. Believe me, I can empathize. However, taxes fall firmly in the arena of politics, and goalposts are constantly being shifted to meet the agenda of whoever happens to be in power at a given time. For example, at one point, President Biden proposed lowering the lifetime exemption to $3.5 million. That haircut in the exemption amount would catch many more estates. If you reserve your spouse's lifetime exemption, you get to take the whole amount with you no matter where the bar is set when you die. So keep this information in the back of your mind in case you ever have to settle your spouse's estate or have a loved one who might benefit from this information. You could save their estate millions of dollars just by sending one form to the IRS. Now, a couple other takeaways. Even though you have 9 months to file Form 706, you can file for an extension of up to 5 years, like I was saying, after the death of a spouse, if the filing is only voluntary in order to allocate the unused exemption to the surviving spouse, which is the scenario I talked about. You should talk with a tax professional or state attorney about this. If you want to really dig into the details, you can check out IRS Revenue Procedure 2022-32, which defines the rules of portability elections. Also, many people with high net worth simply give away cash up to the amount of the exclusion in order to reduce the size of their estate each year. If you're doing well enough and can trust your heirs with an early portion of their inheritance, it's a really good way to soften some of the estate tax blow. Third, none of the estate or gift tax laws apply to gifts to spouses or charity. I think I mentioned that, but just want to be clear, spouses are excluded from all these rules. Another thing to keep in mind is elected officials are always kicking around the idea of changing the lifetime exemption. Odds are it will change from time to time, so don't go planning too much of your life around it. And that puts a bow on our gift tax discussion. I hope you found this information helpful. As always, I am grateful for your interest in our video. Thank you for watching. As always, God bless and take care.